Alrighty guys, this week we're actually gonna go ahead and finish up the accounting cycle for a merchandise company. One of the things that we're gonna do, of course, remember we adjust and then we have to close. So what we're gonna do is we're going to complete the steps so that we can complete the income statement, the owner's equity, and the classified balance sheet. There's gonna be a definition later on for what we mean by classified balance sheet. We're gonna have to journalize adjusting and closing. We're gonna be remembering what we mean by closing, then preparing the post-closing trial balance, and then reversing any entries if we need to. If we've made a mistake and we placed an entry into the wrong area, like maybe using cash when we should have used a payable, or using a expense when it should have been maybe accumulated depreciation. So we're going to be going over those things as well. Now, the income statement, remember, we need to know what the net sales were, not the gross sales. Remember, the net sales are going to be everything that we subtract from our revenue, from our sales, what we've made, how much we've made, and then taking out all of the expenses that are there, the level of returns that were returns, the purchasing discounts, how much did we give, how many were returned to the suppliers. So what is the cost of those goods that have not been sold yet? Then, of course, also the cost of the freight as well. So this is what we're talking about as far as the partial income statement, where you have your gross sales here of $95,000. Then less, notice, the sales and returns allowances. We're taking that out. Sales discounts as well. How much was that? So we add those two together, getting 1,620. We subtract that from the actual sales, and we get $93,380. Now, it gets even better. Now we have to see what is the merchandise of the amount that we had. Remember, we had 19,000, and then we also had our purchases. But we have purchases less our purchasing discounts that we have, and then our purchases, returns, and allowances of the inventory that we don't have, and the discounts that we had on the purchases. So we're going to subtract these two, the purchasing discount and the returns and allowances, okay? Now, this right here is different from the top because this is what we have purchased as a company from other vendors. This is what we've sold, but what customers didn't like and what they brought back. Okay, so there's a difference there. So we have to take that out also, and we add these two together, getting the 1540, and then we have that, and we subtract it. We end up with this amount. So this is what our net purchases was after we returned, after we did the purchasing discounts. So this was how much we had as far as purchasing. We have to add the freight because the freight is a cost to us. And remember, we have to, if we're going to make money, we have to make sure that we put in all our costs as well. How much did it cost us, so that we can make sure that our sales are up what they're supposed to be. Not like Sears, who ended up buying another company that was going down the tubes, which is Kmart, and then you add two companies that are not doing well. What do you have? The closing of a company. So you have to put in all your costs in, and then you get what the net cost of the purchases were. So you add this in. So now you have, instead of 50,460, you now have 50,910. Okay. Now, okay. So this is the net that we have. Then we have the cost of the goods available for sale. How did we get that? Simple. We added the beginning inventory to the cost of the purchases, to the net cost of the purchases, and you end up with $69,910. Okay? But this is the beginning inventory. Okay? So then we take out how much merchandise we have right now at the end of the month. We only have $4,000 worth of inventory. So when we subtract the $4,000 from the $69,910, then the cost of goods sold, which means the cost of the items that we purchased, how much they cost us overall, was $65,910. Okay, so that's all the cost. Now we take this 65,000 and we subtract it from the net sales. Now we have our gross profit. And notice, we had a lot of money in sales, but because of the purchase that we had, the freight, the discounts that we obtained from other vendors, the discounts that we gave our customers, the items that we returned, the items that were returned to us that we don't have anymore, the freight in as well. We find out how much everything cost us throughout that month. So then we can really determine what is our gross profit. And our gross profit, everything after everything was done, was $27,470. This is before expenses. Okay, that's why it says it's a partial income statement. It's not a completed income statement, because with a completed income statement, you're going to end up with even less, because we have to take all of those expenses out as well. Remember, from the profit, we take away all the expenses. So here we go. All the expenses, whether we have salaries, delivery, advertising, depreciation, rent, utilities, supplies, depreciation, office equipment, store equipment if we purchased any, insurance expenses. So then we have to take the operating expenses out. And notice we have salaries in there as well. So when we put all of this, the salaries, the payroll, the depreciation, the supplies, insurance, postage, miscellaneous expenses, then our total operating expenses were $13,625. Okay? So we take that, right, and we show that then our net income from operations was only $13,845. Well, how the heck did you get that? Very simple. If you subtract the operating expenses, which is a total of 13,625, and we subtract it from our gross profit, you end up with the net income from operations after the fact. Then you still have to add in any other income right here. So now we're going to add the rental income, and then any other expenses. Obviously, we have an interest expense on something. So what we do is you take the rental income minus another expense. You only have then the amount of another $100 to add as far as income. So you end up, so you subtract it then again, okay, because the income expense was more than the rental income. So you really have a minus of the $100 here when you subtract it. So you subtract this from the 13,800 and you end up with $13,745. Okay, don't worry, I'll take it slower when we do the homework demonstration. All right. Then from there, of course, we go into statement of owner's equity. So now that we've got our information as far as how much money we made, then you're going to check for any other investments, if there's been any increases in profits, if there's been any decreases from losses, or if the owner has taken out any money. So here we show that with Art had the capital of 750. Here we go. The net income for the year was 13,745. Where do we get that? From the income statement. Minus his withdrawals for the year. He's then taken out $860. So there has been an increase in capital also of $145. So when you take the information of the net income, okay, here, you see that there has been an increase, all right? And then you now look at subtracting the amount that we've got here from what we have here. Okay, notice we're getting that here. We've got the 750 from how much he had at the beginning. We're taking this from here, and then this is the withdrawals that we're taking here. So that's what we see so far. Okay. My apologies. I need better glasses. Maybe I should zoom in a little bit more. Yes, that's what I'm going to do. because here we go. This is where we're getting the capital that he started with. This is how much he had as far as the income for the year, and this is how much he took at the withdrawals. So when you subtract $13,745, and you subtract the 800 $8,600 from there from the withdrawals that he taken. Wasn't 800, it was 8,000. Check your zeros. So you end up with then, of course, the increase in capital that you have of $5,145. So you go ahead and you add that to this, which is actually 7,000, not 700, and you end up with $13,050. Okay, so let's go again. This is not 700, this is 7,000. This is 8,000. This is 13,000. You take that, you put this over here, right? You get this amount that he started with when he began the business of the 7,000. You subtract how much money he's taken out. So when you subtract the actual 8,000 from this, you end up with an increase that he's actually increased his amount of money that he has. So you've got the $5,145. When you add these two together, you end up with the $13,050. Okay? All right. So now we have the classified balance sheet. Okay, the classified balance sheet is actually has more details of assets and liabilities. Okay, it also goes like it's a more complete financial picture. The current assets, of course, are assets that will turn over within 1 year or operating cycle. The cycle is, of course, the time it takes to buy and sell merchandise. Another listed in order is how easy they can be converted into liquidity. So whatever you have as far as equipment, whatever is easy to sell, that's how you start putting them into the classified balance sheet. The accounts then are carried over from the worksheet, which is the cash that he had, petty cash, accounts receivable, merchandise inventory, supplies, and prepaid insurance. And again, the reason that they're in this order is because this is money that people owe you. You can ask them for that money and make it into liquid cash quickly, okay? You can sell your inventory, maybe not as quickly as you can ask for this money. And then, of course, you have supplies. You can sell those in a heartbeat. Prepaid insurance, if you have it there and you haven't used it up, you can always use it as far as cash. So when you add all this together, you end up with $32,420. Long-lived assets, okay? Long-lived assets are used in the production or the sale of goods, which means equipment, building, and land. Okay, it's shown with this contra account, which is the accumulated depreciation, which means then you have your current assets, plant and equipment, your store equipment, and then of course you're taking the less accumulated depreciation because you're keeping the historical value, remember, but we're bringing it down so that we don't have that. We're actually showing then that we're decreasing it in value because we're constantly using it. All right? We're going to get into current liabilities in the next half.